It is now my pleasure to introduce Kaaren Hall. And Kaaren Hall is the owner of uDirect IRA Services. I first met Kaaren and listened to her speak, and I really enjoyed her presentation. And not only that, we later found out as she looked at some of the things that we were doing as a company that we actually had made a mistake that we had to change. And that's what's important about Kaaren, is that she's an expert in her field. Kaaren has over a 16-year background in real estate, property management, and mortgage lending. She's worked at such companies as B of A, Centex and Pulte Homes, and IndyMac Bank. She's held a real estate license in Washington, Texas, and California, and a life and health license in California as well. Her company, uDirect IRA Services, LLC, offers self-directed education and services to investors. Kaaren lives in Orange County, is a proud mom of 2, and she's about to get my IRA account. So Kaaren, welcome. Welcome to our state. Thank you.
What an honor. Thank you so much. What a great breakfast it is. We have to really thank the Norris Group for all their hard work, Diana and Aaron. Thanks, guys. Historic room. It's so lovely. Oh, thanks so much. My name is Kaaren. It's not Karen. It's Kaaren, and I'm the president of uDirect IRA Services. And here's our logo. What we do is we provide self-directed IRAs, and we're an administrator called a TPA. What we don't do is provide investment advice. For that, you can talk to Bruce. We also don't provide legal advice, and we also don't provide tax advice. We've got Amanda and Matt from Keystone CPA here to give you all the tax advice that you need, and they've got some great stuff. And at one point, Keystone CPA was in the same office as uDirect, and it was so handy because people would say to me, well, what kind of plan is best for me? And I would say, well, you can go right down the hall and get some tax advice from Keystone. So now they're just down the street instead of down the hall. So it works out really well. But what we do provide advice on is how to self-direct, and that's what I'm going to talk to you about this morning. And I think I have a clicker. Let's see how it works. All right. All right. Good. Self-direction, I think, has anybody in this room ever not heard a word about a self-directed IRA? No, that's what I thought. A pretty sophisticated crowd. That's great. Well, when you go out and you talk about self-directed IRAs to other people, they'll say, well, you can't do that. You know, it's illegal. You can't. And what I really love is when you speak to somebody who works at a traditional IRA house, like maybe like a TD Ameritrade or a Smith Barney, maybe Vanguard or Fidelity, and you say, you know, I've got an IRA with you. I want to put a house in this IRA. And they don't say that we can't help you. They say, you can't do it. And you can, and you've been able to do this for 36 years. This is nothing new. This has been able, ever since the ERISA laws passed in 1975, you've been able to self-direct your IRA. So don't let anybody tell you that you can't. It's really shocking how few attorneys and CPAs know about this. I've helped over 1,200 people self-direct their IRA over the last 4.5 years, and I found just a handful of CPAs and attorneys that really understood it. All right, so we're going to go forward, is my plan. There we go. So the only difference between a self-directed IRA and a typical IRA, one difference, and that's the asset that the plan can hold. That's the only difference. The money goes in the same way, the money comes out the same way. You can self-direct a traditional, a ROTH, a SEP, a simple, they're all, if it's an IRA, it can be self-directed. So that's good to know. There's even more than that. Oh, and here we're talking about some of the things you can invest in. When you go to the IRS website, you might want to jot this down. It's irs.gov. And because we're going to refer to it a couple of times this morning. One is Publication 590. And doesn't that sound exciting? IRS Publication 590, like you want to rush right home and download it right now? Well, it's good stuff, and it's easily readable. And if you're interested in the rules and you want to research it, this is where you're going to find the rules. And it says that really there are just 2 things that you can't invest in. And that's life insurance policies and collectibles. Everything else is okay. So that's pretty good. There's really one more thing to add to the list, but the IRS didn't put it there, and that's S corporations. And the reason is because an S corp doesn't let a non-human invest in it. So really, when it comes to self-directed IRA, again, it's exactly the same as any IRA. The only difference is the asset, what asset, anything except life insurance and collectibles. So I have some people who have invested in some pretty great things like mango trees in the Philippines. I love this. You can buy a mango tree when it's like this, and literally your investment grows. And then when they harvest it, the harvest, you know, they sell the harvest, the money goes right back in your IRA, tax-free or tax-deferred. Pretty great, huh? I think if you've ever heard me speak before, you've heard me talk about this guy. a young man who had a Roth IRA, and his idea was to take his Roth IRA money and use it to buy tickets to the Super Bowl. And by buying tickets to the Super Bowl, thank you. And so he bought tickets to the Super Bowl. Yes, if he had gone to the Super Bowl, that would be a prohibited transaction because he would have personal benefit. That would have been bad, but he didn't. He sold the tickets at a profit, and that profit went back in his IRA, Roth IRA, tax-free for life. I mean, how creative is that, right? I mean, if you're at a dinner party, this happened to a friend of mine. She's at a dinner party. Her next-door neighbor was lamenting he couldn't get a car loan. And she says, well, you know, I have an IRA, and it was her first deal. And so she lent, I mean, you have to know these people, right? But she lent her neighbor the money to buy a car from her IRA. He paid her IRA back every month, went right back in the IRA, tax-free or tax-deferred. So really, if you know, you're a room of investors, you're creative people, just know that it's anything except life insurance and collectibles. All right, so now we have a new clicker, and we're going to go with this. All right, we'll pretend it moved forward. And if it did, it would probably tell you something about employment. There we go. And this is really, really important. I was sitting out in the lobby before we got started this morning, and I think I had 3 people ask me about this. That if you're still working and you're with an employer that has a 401k plan, a 403b, a 457, can you self-direct that now into real estate? And the answer is probably not. What you need to do is go to that plan administrator and ask for what's called an in-service transfer. That's something to write down. An in-service transfer. Because either it's going to be your money you're going to ask about, or it's going to be your investor's money you're asking about, somebody who's going to invest in your deal. If they go to the plan administrator, sometimes if they're 59 and a half, they can get this. I've had one person get it out of 1,200 people. So not really common, but it's doable. So in-service transfer. Otherwise, you have to wait till you leave employment, and then you can roll over. So just think about how many people have changed jobs in the last few years. I mean, pretty much everyone I know. And so almost everyone I know has an orphan 401k that they can roll over into a self-directed IRA to invest in your deals, you see. So it's a lot of people. In fact, I had the great privilege of sitting next to Bruce and Aaron earlier this year in Washington, D.C. at this thing called RETA, the Retirement Industry Trust Association that we both belong to. And at that meeting, we learned that there's something like $15.7 trillion in retirement money. Wow. Okay, that's a lot of money. Just think about how we could take that money and put it to use at a grassroots level here to do exactly what Bruce was talking about. Get these houses you wouldn't let your cat walk into and turn them into beautiful show places. I love it. It's such a wonderful thing. Everybody benefits. Well, guess what? $15.7 trillion can go into those deals. Can go into gold, can go into notes, can go into mango trees, whatever you want. Lots of money. Only about 4% is self-directed. So that's what we learned in Washington. All right, there we go, IRS. Gotta love them. And we're gonna talk a little bit about the rules of self-directing, and this is what I spend most of my day doing on the phone. People have such really great ideas about what they wanna do for investing, but sometimes you can't do it. So, and a lot of these rules aren't self-evident. You wouldn't just say, oh, of course, everyone knows that. No, that's never the case with the self-directed IRA and the IRS. So, here are some of the rules. One, you're not going to borrow money from it but there's an exception, which I'll tell you about later. If you have properties now, you're not going to put them in the IRA. That's a prohibited transaction. So you can't, if you have an asset today, it doesn't go in the IRA, okay? You're not going to use it as security for a loan, and you're not going to use it to buy property for personal use, either present or future. Your intention needs to be for retirement purposes only, okay? That's the whole thing, retirement purposes only, right? And one of the things that they're really looking at is present benefit, which we'll talk about here on this next slide. And okay, first we're going to talk about who's allowed and who's disallowed. No, is Amanda in the room? Okay. Amanda, so we're trying to figure this out. Amanda's a CPA, and we're trying to figure out how did they come up with this rule. This is IRS. The people who are disqualified to your IRA are your lineal ascendants and descendants, okay? Your parents and grandparents and their spouses, you and your spouse, your children, your grandchildren, and their spouses, like this. So Amanda, being an only child, said, I bet that person was an only child. They weren't thinking, about anybody else. Or it could just be the line of inheritance. Who inherits your things? Those people are disallowed. So your IRA is never going to buy an asset that your child owns. Your IRA is never going to buy an asset you own or that your parents or grandparents own. You see this line. However, your IRA can buy an asset that these people own. There we go. All the people out to the side, your nieces and nephews, your cousins, your brothers and sisters. So say, for example, You find a really great deal on a rental property right near UC Riverside. You think, fabulous, I'll rent this to college students. And so you've got this place, and so you decide what you're going to do is you're going to rent this out to kids, and your son needs a place to stay. Sorry, your son can't rent it, but your nephew can. Your nephew can stay in there all day. Maybe it needs to be painted. Your dad can't do the painting, and you can't do the painting, but your brother could, or your uncle could come in and do all the rehab work for you. Isn't that interesting? You wouldn't just assume that. So that's really important to know. I have people all the time coming up with these great ideas, but that runs into this problem about disallowed people. And one of the things that's really important to know is that you're not allowed to provide goods, services, or facilities to the plan, which we'll talk about here on this next slide. These are the 3 buckets of prohibited transactions. All right, and we've kind of gone over them, but I have a story. Neither you nor a disqualified person can have present benefit or indirect benefit from your IRA until you retire, until you take the money out, right? So here's a story. So I had this just really lovely gentleman come in my office, so excited because he's going to invest his IRA, really excited to do it. And he has this piece of paper in his hand, and he slams it down, on my desk and says, okay, how do I fill that out? I thought, well, what is it? And it's a note. Well, first off, I'm not going to give him investment advice. I'm not going to give him legal advice. So I introduced him to an attorney that wrote up a proper note for his situation. It was just something you printed offline. So number 1, know your asset. That's the first thing. But I said, well, okay, you're going to loan money. This is great. Who are you going to loan this money to? And he said, well, I'm going to loan the money to my sister-in-law. I said, great. Your sister-in-law is one of these people, right? She's out to the side. Fantastic. So I said, well, when your sister-in-law gets this money, what's she going to do with it? He says, oh, well, she's going to invest it in my company. No, you can't do that. That is prohibited transaction because the IRS has something called the indirect rule. If you can't do it like this, you're not going to lend it to him, who lends it to her, who gives it to your business. It's where does it start and where does it end is what they're going to take a look at. So that's real important to know. And again, creative people, it's like, oh, I know what I'll do. I'll form an LLC, and then I'll have my IRA lend to my LLC, and it's just like just a soup of prohibited transactions. Just keep it clean. Arm's length is the rule. Just think arm's length. All right, number 2, we've kind of covered this, but you can't buy, sell, or exchange between the plan and a disqualified person. Somebody has said to me here, well, Kaaren, what if you pass away? That's different. That's called a transfer, and that's allowed. So you can transfer your IRA to a disallowed person, but you can't buy, sell, or exchange it between you and a disqualified person. And then the third thing, it's just a couple little words, and this is where everyone gets stuck. And that's that a disqualified person, disallowed person, can't provide goods, services, or facilities to the plan. So say, for example, you work at the Norris Group, and you are making loans all day long for the Norris Group, and you think, this is a great thing. I want to invest my IRA in the Norris Group. Well, guess what? You provide services to the plan, don't you? Yeah, you can't do it. Guess what? Anybody in here a realtor? I bet we have a few realtors, don't we? And your mom's IRA is going to buy a house. Well, of course you want to help your mother. You are the expert. You understand the market. You know exactly what's going on. You can give her the best possible advice. Do you think you can be the realtor on that deal? No, and you sure can't take a commission. You need to keep everything at arm's length. There are those deals when you're a real estate agent, you just have to give to your buddy, and then when they have those deals, they have to give to you, and you just trade them off. But keep everything arm's length, no goods, no services to the plan. That's also sweat equity. You know how they tax you when you die? We were talking about estate tax in the back. They tax you when you sweat, okay? So if you get in there and you start doing all the work on that, the IRS calls it an overcontribution of sweat equity, and it becomes a taxable event and a prohibited transaction. So don't do it. Just, again, with the arm's length, all right? Okay, let's move forward. So how does the self-directed IRA work? It's no mystery. It's not difficult. It's really not. And that's what I'm here to do, is really dispel any kind of idea that this would be difficult to do at all. But if you just understand a few basic things like the rules that I've covered and this, there's you and then there's your IRA, and you're 2 separate entities legally. So say you're buying a house, okay, and you've got the offer to purchase. The name on that offer to purchase isn't you, it's custodian for the benefit of your IRA, right? It's like this. And custodian for the benefit of your IRA. And guess who signs that document? Not you, but we do. We have the custodian sign that document and take care of it for you. So that's how it works. uDirect IRA Services is a third-party administrator. Everything, we're your point of contact, and I have enlisted the services of a trust company called American Estate and Trust in Nevada to hold the money. They pay, by the way, 1% on idle cash, which is like kind of, right now, better than a CD. And the reason I chose a trust company is because it's non-depository. You know, they're not making loans, there's no checking and savings, and how many banks have gone out of business? So I thought a bank probably wouldn't be the best custodian, I'll pick a trust company. So this is the structure. Okay, let's move on. Okay, buying real estate with an IRA, about every 6 months or so, this article starts circulating again on the internet, and they'll say, whatever you do, don't buy real estate with an IRA. They'll talk, and because you know, it's so difficult, but it's not. So we'll talk about that. The bright side, the upside, I think, first off, is that this is where the money is, like I was explaining. You know, trillions of dollars in retirement money, but also because all the money that comes back in is tax-free or tax-deferred. So, and that kind of goes to this bottom point here about earning a large rate of return. You buy a house, it's $100,000, you sell it for $200, the $200 goes back into your IRA. Guess what? The whole $200 can go out into your next deal. It's not being diminished by tax, and that helps you compound your growth faster, doesn't it? When you can put the whole thing back into the next deal. Also, no time limit for holding property. I heard the 1031 exchange conversation happening today too. Anybody ever do a 1031 exchange? Yeah, that or a root canal, right? I mean, how fun was that, right? Because you've got to identify, 90 days to identify, 180 days to close. You hope you close on the property you identified, and it's stressful. In an IRA, you buy it today, sell it tomorrow. Buy it today, sell it in 29 years. Somebody asked me if there was some kind of 2-year rule. No, there are no time rules inside an IRA. That's great. It gives you a lot of freedom. And the IRA can borrow money. And guess who makes loans to IRAs? The Norse Group. So we'll talk about that too. All right, let's go forward. The downside of buying your IRA, the article I was mentioning, says, well, guess what? When your IRA buys a piece of property, you don't get to take any tax write-offs. And that's true. So do you think maybe it would be a good idea to own real estate inside and outside an IRA? You know, probably. But if your IRA has money in it, you have to ask yourself, how do you feel having your IRA in the stock market? Or how do you feel having control of your IRA in an asset that you understand, that you're in control of? And that's really the question here. So you've got the money anyway. How are you going to put it to work? Most people in here, I believe, are real estate investors. If real estate's your thing and you understand it, then maybe that makes the most sense for you, right? So that's really one of the great things about a self-directed IRA. You're not going to be taking any deductions for capital loss or depreciation, but you know what's great is when you sell the property, you don't have to add back the depreciation. That's kind of nice too. So you don't have to worry about any of these issues. Any losses, like any IRA, they can't be replaced. You're not going to take a write-off if you have a loss. And of course, any loss is very difficult to replace because you've got contribution limits. So like I say, with any asset, just do your due diligence. Do a little homework first. Make sure you're making a good decision. All right, let's go forward. Now, the IRA can take a loan, and as I mentioned, the Norse Group happens to be on my list of non-recourse lenders. They started doing that this year, and I'm really happy that they have, because this is a very useful tool. Now, basically with a non-recourse lender, what it means is that in case of default, the lender can't come against you, and they're not going to come against any asset in your IRA except the subject property. That's their only recourse. All right, next slide. And so with this, not a lot of lenders to choose from. I used to have a list like this, now it's like this. Because of course the lending industry in itself, not a lot of lenders to choose from, typically a higher down payment, and we all know with loans it's based on risk and what they're going to require. But it could be 50%. When I first started, this was it said 25% on my slide. So it just depends on the situation. But what they want to see, it's not a loan made to you. It's not about your FICO score. It's not about how long you've worked at your job. It's not about other factors like that. It's about the property and its location, its condition, but mostly it's cash flow. And a lot of times these lenders want to see that you have like a rental agreement in place to make sure that the cash flow is going to be there once it closes. So you're not going to, also let's go to the next slide, you can't personally guarantee the loan to the IRA, but if somebody is not disqualified, they can certainly guarantee that. All right, next slide. And so we're going to move on to tax. An IRA can be taxed. What? I was really surprised when I heard this, and I'm sure you are too. If an IRA borrows money, it can be subject to this tax. And it's called UDFI, Unrelated Debt Financed Income Tax. And so I'll try to do this in about 1 minute, explain it to you. The IRA, say you've got a property, you buy a house, 50% leveraged, right? So 50% of the proceeds would be based on this UDFI tax, which, as Amanda Hahn, the CPA, explained to me, is at the estate tax rate, which is now 35%. So does it make sense for you to get into a deal with leverage? It could. That's why you have a good tax advisor to say, hey, look, this is what I'm going to do. this is the purchase price, these are my closing costs, this is going to be the tax at the end. Does this pencil out? And get some advice about it, because it could be a great deal for you. You could have write-offs or have something else, and you could have a great deal. So begin with the end in mind, pencil it out first, and see if maybe this won't make any difference to you in your deal whatsoever. All right, next slide. Anybody in here do flipping? Flipping houses. Yeah, that's fun, isn't it? I mean, it's great fun. But guess what? In an IRA, if you do more than 3, they call it running a business. And you know what? That's not written down anywhere. That's what I love about the IRS. That isn't written down in the IRS tax code, that if the 3 houses equals running a business, or 4 houses would be. It's kind of a rule of thumb. So you want to make sure that you're not running a business in your IRA. But the good news is, where you're limited by contribution, how much you can write a check for and put in your IRA, you're not limited by how many IRAs you could have. It's unlimited, infinite. So maybe you've got enough, maybe you open 2 IRAs. This one does 3, and this one does 3, and this one does 3. Just as long as you limit it so that you're not running a business in your IRA. And again, get tax advice and get some good advice before you go through this. But read about it. Remember irs.gov, the website I gave you at the beginning? Look up Pub 598 if you're interested in these taxes. And straight from the mouth of the IRS. I mean, it's not Internal Revenue Code. It's like distilled into a publication. But it's good stuff, easily readable. All right, let's go forward. Oh, and your CPA will report it on a 990T, it's called. So how do you get a house into an IRA? It's not difficult. It's very easy. You know how you get a stock in your IRA, right? You pick up the phone. Hey, I want 100 shares of Apple. Thank you very much. And you give them you give them limits. And the next thing you know, there's the stock. You see it online. Hey, got a stock in my IRA. Well, a house is obviously a little bit more difficult, because the houses are more difficult. I mean, has anybody ever here in this room bought a house where it wasn't a total train wreck? I'm just asking. A laugh. I think everybody's still asleep. But it's seriously, because there's always, the appraisal might not come in, and there's always some stress, and there's always some little thing. Well, when an IRA is involved, it doesn't have to be more complicated. In fact, it can make it a lot easier, because it's basically a cash transaction. So keep that in mind, that when an IRA is involved, it's like dealing with an all-cash deal. Just one difference is how it's titled. So to get the IRA and get the house in the IRA, it may seem simple to say, but open the IRA first. Because guess what? You open the self-directed IRA, day 1 you've got an account, no problem. Now the next step is to get that IRA funded. So you take the money from where it is and you put it in your self-directed IRA. Well, we've got to rely on a third-party custodian to transfer that money over, and they can take their time. And they can reject your transfer request, and it can take a couple weeks. So if you find a house today, or if you find a deal today, maybe you want to make a trust deed, and you've got this perfect opportunity, you want to move on it today, well, unless the money's in your IRA, you can't. If it's a house and you need an earnest money, that's a problem. So open the account, get it funded, and then go shopping. Then start to look for your deals, because then you won't be disappointed, right? Because then you'll have everything that you need. So the next step is that you've got the offer to purchase. So you've got the offer to purchase and a direction letter, and you give it to us. We sign it. You tell us how much to disperse. We disperse the money, right? And so then funds are wired. Then you fund, you record, you get your keys, right? You hope your tenants move in right away. And guess who they're going to make their check payable to at this point? Custodian for the benefit of your IRA, like that. All right, well, this is long. So be nice to your tenants and get them a rubber stamp so they can just stamp it, because it's a lot. They're going to get writer's cramp. And who writes anymore? Everybody types. So that might be a nice thing to do. But there are other ways to do this, too. If your IRA owns a property outright, one of the things to do might be to get a property manager, and it could make things a lot easier when it comes to repairs. I think this is a good time to talk about this. All expenses of the IRA are paid for by the IRA. Closing costs, IRA pays for them. Improvements, IRA pays. If you're creating a checkbook IRA, which we'll talk about later, the IRA pays the attorney's fees. So any expense of the IRA gets paid for by the IRA. So, what if you have a water heater and it's Saturday at 3 in the morning, because that's when they break? You ever notice that? And then you wake up and the carpet feels like SeaWorld. And so if you've got to get this fixed and it's a weekend and you need a check, well, guess what? You're not going to do the work yourself. That would be an overcontribution of sweat equity, so you're not going to go there. So you need someone to fix this thing right now. Well, if you have a property manager, you've got somebody who can do it, pay for it, and your IRA can reimburse them. That makes it really easy. Because what makes it difficult is waiting to call me on Monday morning, say, hey, Kaaren, this happened, I need a check. I said, great, give me an invoice and a direction letter. We'll mail a check back to you. So by next Saturday, you've got the check, or we could wire it to your bank account. That takes a little while, right? So the other way to do it, we'll talk about, is maybe with the checkbook IRA, a third way, where your tenants can make their checks payable, and then you can have a checkbook control and easy access. All right, let's move forward. Oh, hey, okay, father and son buy a house together. Aren't these happy guys? I should change this and put Aaron and Bruce is what I should. I just was looking for, if you have a better picture of a father and son, I haven't seen a good picture of Aaron and Bruce. Maybe I'll start to use that. But okay, so here they are. They're serious people. These guys want to make some money, okay? So dad's going to come in with cash. The son's got a traditional IRA. But wait a minute, Kaaren, you say, these people are disallowed, right? Lineal, ascendant, and descendant. They can't do that. Oh, yeah, they can. And you know why? Because they're going to close concurrently. We'll get to that. So here's how title reads. Custodian for the benefit of son's IRA, 50% owner, dad, 50% owner, tenants in common. All right, next slide. So, yeah, they're prohibited. Yeah, they're disallowed to each other, except in this situation, neither the son nor the father had any ownership interest in the property beforehand. So they're going to close concurrently, and it's okay. Now, go ahead and change the slide. And after the deal, that's when it becomes a prohibited transaction. So father and son will never sell their portion to each other. They're never going to stay there. They're going to have no personal use of the property, you know, and that sort of thing. So you want to make sure you follow the rules. And there they are, okay? And so let's go to the next slide. Now, after the deal, they're never going to buy each other out, but here's how it works. Now, property tax bill comes due. Dad comes in with 50% from his cash. Son comes in with 50% from his IRA, and they pay it. The rent comes in, maybe to a property manager, or the tenant would have to write 2 checks in this case, right? So maybe there's a property manager, and they're going to get all the money in, and then they're going to split it out, 50% to dad, 50% to son's IRA. That's how it's going to go. Expenses and income. All right, let's go forward. Now, real estate is such an awesome asset. I mean, I love it. That's my background. I mean, everybody has their thing. And I have never seen a property in my life, if you have, you just tell me, that didn't need something you didn't have to spend money on. A house is like a living thing. Something's going to break. It doesn't matter if it's new construction, the tenant, you know, the construction people just walked away. You still have to put, you know, mini blinds and landscaping. You have to do something on every property. So what if you run out of money in your IRA, right? Because your IRA pays all the expenses. Well, here are 6 things. If you forget, say, hey, Kaaren, what were those 6 things? And I'll tell you. But basically, you can write a check. If your self-directed IRA, say, has gold in a house, you could sell some of the gold and take the cash and make do. Say it's a tax bill, and pay that tax bill. Maybe you've got 2 IRAs, a self-directed IRA here, and over here you have like a typical IRA, like at Fidelity or something. Sell some of your stock, money goes to pay the tax bill. Say none of that's going to work for you. You could bring on a partner as long as they're not disallowed. Or you could take on a loan, a non-recourse loan, probably from an individual who's not, you know, who's okay, somebody who's out here. You could do that. And if none of that works, you could just sell the property. All right? These are the things that you can do. You know that there's a solution. Okay, let's move forward. Yeah, the checkbook IRA. Everybody loves this. People will open an account with me and say, hey, Kaaren, when do I get my checkbook? So it's important to understand this too, and I offer a free class on this, usually once a month in Orange with an attorney. If you can't make it, please send me an email. I have my information on your table. There's information out here if you want my email address. I have a link to, I recorded this event that I do with the attorney. And I took a class in Atlanta. It was 2 days. I sat there for 16 hours listening to 2 attorneys and a CPA. I mean, talk about drinking from a fire hose, right? It was just so much information. So I'm going to tell you what I learned in 5 minutes. Okay, ready? All right, here we go. Self-Directed IRA. It's open and has money. All right? Special purpose LLC, not LegalZoom.com, not prepaid legal. Not that there's anything wrong with that, except that you want to make sure that this is done right. It has to have special language in it. You want it to be compliant with the IRS, don't you? So you have your IRA buy the initial units of this LLC. IRA owns the LLC now, and the money goes from the IRA into the LLC's checking account. Guess who's the managing member? You are. That's right, and you are too. And so are you. And now you've got checkbook control, so you can write checks. Well, sounds like a beautiful thing, doesn't it, Ruth? Except, we were talking about that this morning. Here's what happens. You're paying an attorney $1 to $2 grand to set it up. If you live in California, we have the great privilege of paying the California Franchise Tax Board $800 a year, right? For the LLC, right. So there are some expenses incurred, but it gives you asset protection, it gives you checkbook control. Does it make sense? You know, we've got attorneys, we've got resources. Give me a call and I'll help you with this. All right, let's go to the next slide and we're going to wrap it up here. One more slide, please. What can you self-direct? It's not just IRAs. It's all these plans. Now, I'm not offering the employer plans, the four plan, the fours up here. I'm not offering the DBs, and I'm not offering the profit sharing for me. But you can they're inherently self-directable. They're employer plans. They're more complex. You have to file more things. It's for an employer with W-2 employees. But anybody here self-employed? Yeah, right? The individual K is something to look at and talk to your tax advisor about. It has lots of advantages. I'm going to tell you about 4 of the advantages of the solo K, just so you know. Number 1, you can borrow money. You can have a non-recourse loan in your solo K, and guess what? You don't owe that UDFI tax that we talked about. All right? Yay. Number 2, if you have one of these other accounts, these IRAs, your retirement age is 59 and a half. In the solo K, it's 55. Even better. Ever hear of a ROTH, how the money is tax-free for life? Well, guess what? If you make over $100,000, you can't contribute to it. But the solo K, you can have what's called a ROTH bucket. And instead of just putting the measly $5,000 a year that you can in a ROTH, now you can put, effective next year, $17,000 a year in the ROTH bucket of your solo K. Wow, right? That's great. All right. And that's with no income ceiling. And the 4th thing is you can borrow money from your individual K account. $50,000 or 50%, whichever is less. Now, if you're going to borrow from it, make sure you make a contribution so it doesn't look like present benefit, but you can do it, all right? So now I've just got a couple more minutes, and we'll go forward to the next slide. Know that all these are self-directable. How do you do this? How do you self-direct? A 3-step process. You open, you fund, you invest. Open an account. We've got a form online. You type on it. It's form fillable. Send it to me with some documentation. Now you fund your account either by writing a check called a contribution. You transfer an IRA to IRA. That's a transfer. You use our paperwork, our form. Or if you have an old employer plan, it's called a rollover. You fill out their form and get the money in your IRA. So you've opened it. It's funded. Now you tell me what you're going to invest in. And that's a beautiful thing. It's your choice. All right, next slide. This is my slide for more information. It's khall at the letter U, uDirectIRA.com.
We had some great questions online. You ready for a few?
I am. Bring
Okay. When holding a trust deed, who should be named as additionally insured?
Okay, let's start with the good one. When naming a trust deed, who should be named as the additional insured? Yeah, I don't know. We'd have to look into that. You're talking about when
He didn't clarify, so we can do that later.
yeah,
That's fine.
and we're talking about insurance, and we're talking about trust deeds, and why would you name an insured person on a trust deed?
I don't know.
It sounds more like an insurance question.
I'm sure
It would
you
be
get,
the custodian.
I'm sure you get this one quite a bit. Can my Roth borrow personal funds from me and pay me an interest rate?
Oh, I love that question. No. No way. Oh, I love that. People have all kinds of misconceptions. Your Roth never lends money to you. You never lend money to your Roth. Wow, I got a call that, yeah, the answer is no. Okay, I have a story, but I'll just, for time.
In the example of father of son, and I'll give you a picture of me and dad, that would be great.
Okay, oh yeah, I will.
What happens with the IRA after the father dies? Can the father's half be willed to the son?
Absolutely. We were talking about that before. You can't buy, sell, or exchange property between the plan and a disqualified person, but you can transfer. And so it's crucial that when you fill out an IRA application, whether it's with me or with anybody for any kind of IRA account, that you always, always, always name your beneficiary. And when you name your beneficiary, that means upon your death, they instantaneously receive that IRA. It doesn't go through probate. They instantly have that account. I've seen it happen, unfortunately, but I've seen a live example where one of my clients passed away. Instantly, both his sons had inherited IRAs.
Questions?
He's talking about the transaction you showed where the father owns.
Okay, we're gonna mic you for this really good question that you have.
I think the person wanted to know what happened to the 50% ownership in the real estate transaction that you showed earlier.
The additional insured in that case, well, it would be, yeah. And the real estate, the real estate is an asset that's owned by the plan, and it would be retitled.
The father owned the cash part of it, not the IRA, wasn't it?
Oh, I see. Well, the father owns the cash. Then what happens to the cash part? Well, then it's part of his personal estate, isn't it? And this is where you ask an estate planning attorney what happens. But basically, I would tend to think, not being an estate planning attorney, that money would just be like any other asset that father personally owned. It would passed to his, passed through his estate. Yes?
Can you have property in a self-directed retirement plan? I was trying to talk loud, so I was. In a self-directed retirement plan, you can own property, and then, and this might be something to do with the trust deed. If you do a seller-financed sale on that property that's owned in the self-directed retirement plan.
Yes, you can do seller financing in a self-directed IRA. In fact, a good way to structure it is to really kind of partner with that seller in the deal where they're still a partner and have part ownership, and your IRA can. I've seen it happen that way.
Where you partner up with the person.
Mm-hmm. Yeah. Yes. Aaron.
You mentioned that the unrelated debt finance tax was
Yes.
was it 35%?
Well, it's, Amanda and Matt, the tax experts, can confirm this, but I believe it's at the same rate as the estate tax rate, which is presently 35%.
Tell us what the unrelated business tax is.
The unrelated, the UBIT,
Yeah.
unrelated business income tax is when your IRA runs a business, and it's kind of appropriate. Here we are in a room that very clearly used to be a church, and it kind of started with the Catholic Church. Catholic Church has this situation where they're tax exempt, right? So they have a bakery. Well, that's an unrelated business, isn't it? An IRA is a tax exempt entity. What if the IRA is running a business like a bakery? And then there's Joe across the street. Well, he's not tax exempt. He has to pay the tax. So the IRS has come in and very graciously has offered to even the playing field, and they'll tax the tax exempt entity with UBIT tax, so that now Joe and the Catholic Church, Joe and the IRA, the tax exempt entity, are an even playing field. That's kind of the origin of that tax. Does that make sense?
It does. And what is the current rate on that?
It's
right
the
now?
same as the UDFI. But again, tax advice, tax expert. Diana.
Can HSAs also invest in the same things as the IRAs you were mentioning?
Excellent question. An HSA, health savings account, goes like this. Yes, it can be self-directed. You talk to your health insurance agent first. That's where you start. Do I qualify for a high deductible health plan? Yes or no. It could be no. But if you do, you get a HDHP, high deductible health plan. It's a beautiful thing. Then you can have an HSA that goes together with this. The HSA is where you can put your own money. It's $5,900, $5,950 a year if you're a couple, like $3,450 if you're a single person that you can put in there per year. Either that money can be invested in the stock market, or yes, you can have one with us where that money that's sitting in there, that's just idling there, can be self-directed. And that's really a cool thing, because then guess what? It goes in tax-free, it grows tax-free, and if you use that HSA money for a huge list of expenses that are on the Department of Treasury's website, it comes out tax-free for life. When do you get tax-free money? It's the HSA. So that's a great question. Yes?
I know your example was about purchasing real estate earlier, but let's say a friend of mine and I decided we wanted to go 50-50 on a trust deed from the Norris Group.
Okay.
Can we do the same thing where he does 50% cash and I do?
Absolutely. You
Okay.
can absolutely partner with anyone on your deal. And absolutely, you and a friend, 50-50 or 70-30, whatever the percentage you want, all day long. Right, Aaron?
That'd be a question for Craig.
Okay, that'd be a question for Greg. But I mean, as far as we allow it, I mean, the IRS allows it. And I don't know if I have time for maybe one more question. One more question then. And please, if you have questions that I haven't gotten to, please email me and I'd be happy to address any issues that you have. It's khall@udirectira.com. John.
Thank you. It kind of dovetails on that gentleman's question. Can two or more IRAs combine to buy a property?
They can, and when Lorraine and Jim get up here, they'll talk to you about creating a syndication, whether you're pooling funds or not, and whether that's an SEC violation. But yes, you can have multiple people in on one deal. Yeah, you want to be careful and be very respectful of the SEC guidelines. So thank you so much for allowing me to speak to you this morning. And Aaron, thank you so much for the opportunity.